Yeah, I think it's been a difficult year all round, really, for lots of different reasons. We've seen house prices start to peak and then fall. I guess over the last few months, we're starting to see some green shoots with house prices kind of still marginally going up, but it is fairly marginal, and it is quite regionally focused as well. Overall, transactions in the market have dropped significantly. It's definitely in favour of remortgage activity now instead of new mortgages, and that shift has been quite dynamic, I think, in the market. So that is affecting that affects us when we talk about general insurance products, and I think it creates a lot of challenges for mortgage brokers in creating new business opportunities.
Yeah, I'd say, I think, Carl's talked there about, advisors and sort of at the coalface with the problems that they face with the way the market is. But I think with our larger partners, that sort of flows through as well. They have to try and find ways to sort of generate the opportunities for general insurance where they would have been a lot more previously. So, it's down to us to make sure that we offer the right technology and services to have, to make those opportunities really easy to pick up, and hopefully offer the training and support for advisors, whenever they need it, if they want to start picking it up. Well, I think some of the things that Carl picked up on there sort of already touch on that. There's a number of factors that would affect premiums increasing, and ultimately that all flows through to advisors and the clients ultimately having to pay more. Obviously insurers are under pressure. That means that less insurers in the market means that there's more pressure on the insurers left in the market. That means the premiums end up being increased for a number of reasons like that. And what do? When we have to try and make sure that we combat premiums that are increasing in the best way possible. So we've tried to bolster the panel. We'll talk a little bit about that today. We've tried to find new ways to innovate around our technology, where we can hopefully find ways to bring prices down, because we're reducing costs internally as well.
Yeah, I think just to add to that, if you think about the state of the mortgage market as it is right now, and then you have this other thing going on, which is happening in the insurance space, where you're seeing almost an insurance crunch. So you're seeing a reduction in capacity at the same time as general inflation is hitting in. At the same time, the claims inflation is coming in. And premiums are rising quite quickly, and that is having a significant impact on the broker's ability to sell that product. It's also making it a lot more difficult for consumers to find the right product and get at the right price. We've given brokers the opportunity to, with commission changes, so that they can look to kind of bring their commission rates down. And I think it's quite important to note that as we pay commission percentages. And as premiums rise, so does the size of the broker commission in pounds amounts. So there's opportunity there, I think, to try and help the consumer by looking at the overall commission take. But it's definitely a challenge to sell those products now in a market that we're in with increasing rates. But as Gav said, we are looking at bringing on new insurers to the panel. So we've launched one recently, and we've got another one in pipeline to do that soon. And that's what we're trying to do. We're trying to improve the panel, give the brokers choice, and hopefully that's good enough for their consumers.
This is happening at the same time as we're seeing big regulatory change through the Consumer Duty as well, and you've got the fair value requirements coming in. So insurers are being forced to raise their prices, but they have to do it through a prism of still offering fair value to customers, which is possibly the first time they've had to, take that into account. So, it's an interesting time. I think it's been an interesting journey for most of the industry. We were lucky, I think to some degree, lucky in inverted commas, that a lot of the regulatory requirements that underpinned Consumer Duty were almost piloted first within general insurance. So, we had to do fair value assessments well in advance of the Consumer Duty coming into force. We had the general insurance pricing practices, which is, then grew arms and legs in the Consumer Duty across other sectors. So I think we had that head start, and as a result, I think there's been quite a high level of engagement across the industry in both big and small companies, and I think as a result, the FCA has largely been pleased with the reaction of the industry. but I also think there's still probably quite a long way for everybody to go in all sectors. So this is going to be an ongoing piece of work that will probably, be a key focus within most businesses for the next few years at least.
Yeah, I mean, I would say, I think one of the key things we always see with regulation coming through like this, you see different interpretation across the industry, which obviously opens it up to a lot of different options and means that bigger, larger partners that we have different views. And again, to hark back to what we've already sort of talked about, we have to be prepared to offer solutions that are going to suit everybody. While trying to meet the regulator and what they're after. So, there's challenges for advisors with Consumer Duty that are owned by the network. We have to try and work with the networks to make sure we support in the best way. And as Phil was saying, that's going to be continuous, isn't it? It's not going to be something that happens instantly. So we'll just have to keep working with the networks, with the people that we already work with, to see if we can continue to support.
I think generally speaking, right now the mortgage market is flat, and I think it will continue to be very similar to that next year. I suspect that interest rates are probably where they are going to stay, or there or thereabouts. I think that's needed, so that brings some stability back into the market, but there is a way to go yet. You've still got a lot of consumers still out there on fixed rate deals that still haven't, on rates that are beginning with a 0 and a 1 and a 2, so that's got to flow into the market. So that's going to have downward pressure, I think, in terms of house prices. So just generally speaking, I think it's going to be a flat market next year. I think it's still going to be challenging for new mortgages. There'll be plenty of remortgage opportunity there. And as Gavin said before, I think what we need to do is make sure that we're going out to our brokers with the right kind of propositions to help them with that. And particularly we've launched this year with Source Go, which could really help those brokers that are trying to tackle both the cost of the insurance and a remortgage customer. Yeah, I think there are several things to do here. So just as I mentioned before, I think new mortgage opportunities are going to be fewer and further between. So focusing on the back book. You've got remortgage opportunities there, absolutely, but focus on the back book. If you've done a 2, 3 or 5 year fixed rate mortgage deal for a customer, revisit that customer and talk about their home insurance every year. Opportunity to communicate with them, and you will definitely be looking to try and save them some money, especially at the minute. So I think that's a huge opportunity for mortgage brokers. I would also say the buy-to-let market is something to continue to focus at. It is a challenging market for lots of different reasons. I don't think the government has helped that market a great deal over the last few years. You've seen a lot of part-time landlords exit, but there's still huge opportunity there. So I think there's a place there for mortgage brokers to think about in terms of buy-to-let insurance, where we can help as well.
Just to pick up on one of the points Carl made there about mortgage brokers revisiting their clients who are coming off, fixed rates, for example. One of the things we've seen coming through the Consumer Duty and particularly the fair value rules is about how brokers offer long-term value to their customers and actually revisiting them on an annual basis around their insurance renewal.
Yes.
It's probably a really good way of both meeting the spirit and the rules of the Consumer Duty as far as general insurance goes. So it becomes less of a one and done kind of sale and more folded into an ongoing service that the broker provides to their customer.
Yeah, and the only thing we would add to that is, if it's a great opportunity right now to speak to a customer and say, look, can I try and help you save some money? Because everybody is looking for that, for that kind of help.
I think there's a number of ways and a number of processes that we'd encourage advisors to implement, and as well as advisors themselves in larger organisations, because I think it's building from the ground up, building a process that's that you can repeat every year rather than just a transactional original sort of sale and then sort of hands wash. And again, it goes back to Consumer Duty and the whole spirit of what the regulator is trying to sort of embody in terms of speak to your clients regularly. So in terms of what do you do in the basics, introduce general insurance conversations early on when you have a mortgage, when you're having a mortgage discussion, and make sure it's part of every mortgage discussion, whether or not it's a purchase, remo, product transfer, all of those sorts of things. Again, if you're engaging annually with a client because of general insurance, that doesn't just mean that you need to talk about general insurance at the time. An annual review is part of many other facets of financial services anyway. Why wouldn't you try and create the opportunity to speak to your clients more regularly in the mortgage side, which is, as I said, traditionally more transactional? I think really it's about bringing that culture within firms to ensure that it's a real fundamental sort of cornerstone of the overall holistic sort of advice, and that really that's quite a big change, I think, for the majority of brokers in the UK. But we're working towards helping people do it easily.
General observation would be that there have been some fairly small changes, I would say, introduced in the general insurances market as a result of Consumer Duty, because we were ahead of the curve on a lot of things. I think the general insurance pricing practices, the long-term impact on the market of those is still to play out, and I think that might have an impact on how we view fair value in the longer term. There is a lot of ambiguity around some of the Consumer Duty requirements and what they actually mean to firms in different sectors, and actually I think fair value is going to be one of those that gets a lot of both scrutiny but also feedback over the next 12 months. So I would probably say that's probably the most pressing issue for the FCA from a embedding Consumer Duty point of view, is to make sure everybody understands what they mean by fair value, and can work on it. So I think that's going to be a key area of focus in the next 12 months, and therefore it's the one that the industry hasn't quite got to grips with yet as a whole, but we're moving in the right direction. But it's a journey rather than a destination, I think.
Yeah, and for me, I think the last thing I would say on consumer duty is it's an opportunity. It is an absolute opportunity, and the regulator is kind of really only asking financial advisors and mortgage brokers to kind of do really what they've been doing very well over the years, which is to make sure that they are meeting the customer's financial requirements, their financial needs, and home insurance is one of those. If you're buying a property, or if you're remortgaging and you're taking out mortgage, you need home insurance. So there is absolutely a need there to discuss. So I think there's a huge opportunity to use the consumer duty to your advantage in that sale. You've got a general election coming next year, so I don't think you'll see much in terms of dynamic change in that market. What is for certain is that there is a huge shortage of supply in the rental sector, and that will continue. If anything, that might get worse. So you'll see that continue, and the trend that you'll get associated with that is you'll see rents continue to rise. There are clearly opportunities in that market for those brokers that want to take advantage of landlords that are more acquisitive. So therefore, they're now taking advantage to expand their portfolio, that maybe aren't looking for capital growth, but looking to get returns on the property. Sorry, on the rental income, on the yield. So I think there's huge opportunity there. But overall, I think the landlord market will be relatively flat. I would hope that if we do end up with a new government, I would hope that there is some movement in that space. Because it is becoming increasingly squeezed for landlords and making it very difficult for them.
I think for some time now, you guys will probably agree with me, you're getting the same messages from advisors and firms of different sizes, down to your one-man bands, up to your larger businesses. They're as Carl alluded to earlier, you're dealing with a market that is very heavy on the sort of remortgages and product transfers, and what that does is reduce the opportunity for new business. The other thing that advisors have to contend with when the market is like this is they're going back to clients a lot more often to talk about rate changes and things like that, and you're not getting paid every time you do that, unless you're charging a fee every time you have a conversation, which is not traditional in the mortgage market. So those sorts of things mean unfortunately you're still very, very busy, but you're not earning as much as you might have been doing a couple of years ago. So really, we try to make sure that it's easy for advisors to have the technology to be able to introduce those general insurance conversations. And really, it's down to us and our competitors, the people that we work with, to ensure that advisors know that there are the options out there to be able to start doing that. If you're trying to create a new income stream, then why not look at an income stream that you're not utilising at the moment or capitalising on at the moment? And input really easy technology to use and good products, a good panel, and you should be able to get on the right track.
Yeah, I would just add to that, we've got, right now, we've got a really strong buy-to-let panel, so I would absolutely be encouraging brokers to take a look at that. The other thing to bear in mind is, I said at the start of this, is that we're seeing an insurance crunch out there, and it's difficult, and you're seeing claims inflation, you're seeing premium inflation, and rates going up. The insurers have been hurt by the weather, really, by performance on their home books. Landlord insurance generally performs a little bit better. It generally books the trends a little bit, so it still suffers when the home insurance suffers, but it books a trend a little bit. So you're not seeing quite the rate going through on buy-to-let insurance. So again, coupled with a good strong panel, easy quote and buy system, I think there's opportunity there to.
I think Source is a firm that's always taken compliance really seriously, and we've tried to support brokers through that because we recognise that a lot of our long-standing brokers don't have the resources available that Source do. So we've got things like our learning lab, we've got people like Gav that speak one-to-one to brokers, face-to-face. Because we recognise we play an important part in supporting brokers on their journey towards satisfying the FCA. I think more of that is going to be coming down the tracks as we develop our understanding of the consumer duty and what it means to us and our customers, which are the brokers, as well as the policy holders. Because as I said earlier, I think there's a bit of development in that understanding to go for the whole industry. And when we reach moments of clarity about how best to implement something, we will share that with our broker community, and I think they can expect to hear a lot more from us as we get those points of clarity throughout the next 12 months.
Yeah, I would just add to that. I think 2023 has been a difficult year for the market generally. What we've been trying to do is focus on the stuff that Phil just talked about and enhancing our quote and buy technology to make the journey easier for the broker, improving the panel of insurers that we've got, broadening the products that we've got available. They're all things there to help deal with some of those challenges. We've launched SourceGo this year. We've also launched our first own branded home insurance product. Next year you can look to see our new quote and buy system being rolled out. You'll see new insurers coming onto the panel, and you'll see that common policy wording expanded out with more insurers. So we've got lots of exciting things that we're working on, loads to do. We're really looking forward to it. It's going to be another difficult year, I think, next year, but we're hoping that the stuff that we're developing for our advisors is going to really help them.
Well, yeah, I mean, you touched on in the question there in terms of it being the first product that we've manufactured ourselves, which is obviously a really proud moment for us at Source. And really one of the key things we're trying to do more of here at Source is listen to the people that we're providing services to. So we launched the Advisor Insight Forum earlier this year. That is part of what's going to build what we want to do in the future. But in regards to the product itself, LV are backing that product, and ultimately they've implemented something called IHP, which allows us to price it a little bit more competitively. So that's going to be the first initial sort of impact for advisors, and clearly in the market that we've been discussing today, that's quite a crucial element.
Just to add to that, we've gone live with that product now. It's available, it's out there, it can be sold. LV, as Gav said, are the first insurer on our panel to underwrite that. We've also added in Prestige as a new insurer. That is part of quite a deliberate objective to try and help our customers and our brokers to expand the footprint, so we can write more risks and to help them. And obviously we're looking to do more of that going forward over the next sort of 3 to 6 months, and just add to the panel. So as it stands at the minute, that policy wording sits alongside some of the other insurers that we have on the panel, and eventually through next year we'll transition across to a fully common policy worded panel. you've been in the insurance market as long as I have, if you've been in the market that long, you know what used to be considered non-standard is not what is non-standard today, and that can be somebody who may only have had one or two claims, and as insurers have kind of decided to shrink their footprint a little bit, and as other insurers have exited the market, then what I would call those kind of softer non-standard customers have probably been left a little bit disenfranchised. So I think there's a huge opportunity there to help broaden out the footprint and to help make sure we cover some of those customers that brokers may have lost over the last sort of 12 to 18 months.
Yeah, there's a couple of things I think coming down the pipe into next year, but I think Consumer Duty will continue to be the big thing and the development of that, and the FCA have already said that they expect to do some more work on fair value and pricing. So I think that'll be a key FCA focus. Also relevant for our market as well, I think, is the fact that the FCA are going to do more work on the networks and the appointed representatives. New changes or new requirements rather come into place this month in December 2023. So there'll be some follow-up work and some oversight into how those new requirements have been adopted. And then more generally, something for the whole financial services market is this cold call ban that the government have started consulting on, and that might take shape, and the government were quite keen to implement that very, very quickly. So we could see that coming into force next year, and how that might impact on the market, because I think at the moment we don't really have a firm definition of what is and what isn't a cold call. So, I think there are going to be some interesting things to play out of that. So, Compliance Day is never dull, and I don't expect 2024 to be any different.
I think with regards to what we've talked about today, specifically Consumer Duty, you've got advisors are learning about it and still trying to implement how they're going to change their processes and how they're going to change the way they deal with customers and the products they sell. We've been prepared for it and made sure that there are solutions ready. So we talked about Source Go today, talking about high quality products, low pricing. That chimes really well with what Consumer Duty is trying to achieve, and obviously we're trying to make sure that we shout about it, because there are going to be an awful lot of advisors out there that are trying to change their business model to suit the regulatory environment, and we want to be able to say, look, out the box solution, so you can satisfy your customers' needs whenever you're ready to.